Welcome to another audio article from The Intelligent Speculator. This article was published on May 14th, 2020, and the title is How to Predict the Financial Future. So let's get right into it. How to understand the market. You can't time the market. We hear that from well-meaning people every day, particularly in the financial world. And to an extent, they are correct. No one will ever be able to pick absolute tops or absolute bottoms 100% of the time, or probably even the majority of the time. However, if you understand what creates markets to have more buyers than sellers, bull markets, or to have more sellers than buyers, bear markets, then you can have a very good idea from a probability standpoint what will happen to a market when a certain event or series of events occurs. To understand markets, you need to look at the past and what happened to cause markets to fluctuate. For clarification, when I say markets, I'm using a very broad application. It could be currency markets, the US dollar, equity markets like the Dow Jones, commodity markets, gold, silver, oil, or even bond markets, i.e. US Treasury 10-year. And all of those have different cause and effect relationships on how humans price them. For example, when our central bank, the Federal Reserve, raises interest rates on loans, it causes a contraction in lending because more people cannot afford loans or are unwilling to take on more loans due to the higher interest rates. As a result, equity markets contract and fall in value in most cases. However, the dollar market in most cases will rise as a result of that event, the cause against other markets like commodities, gold, silver, and oil, because the dollar is in higher demand due to less of them being available. As such, you can buy more of a specific commodity with a single dollar. However, when the Federal Reserve reduces interest rates, credit flows more freely, allowing people to spend more. This creates more demand for products and services. That increased demand causes equity markets to go higher and commodity prices to rise. So our current situation. After reading the above example, you may be wondering, but didn't the Federal Reserve just lower interest rates to 0% a month ago, and oil not only went down but negative? So shouldn't the opposite occur? The main reason for this happening was also very predictable from a probability standpoint. When the Federal Reserve cuts interest rates, it does so when it believes the economy is contracting and more money needs to be put in the system to increase lending and stimulate demand. In most regular boom-bust credit cycles, cutting interest rates to 0% would have caused markets to eventually bottom out and then muddle before it would begin a new bull market, since credit would expand, money would be lent, and people would start spending again. But because the global pandemic COVID-19 popped, the largest credit-created economy in history, we already had historically low interest rates, which drastically limits the effect of a rate cut. So now we have a problem in the economy where even 0% or negative interest rates will not stimulate demand because we've reached peak debt. Historically, peak debt is when a nation has 200% to 300% of debt to their annual economic output. And when you combine government, corporate, and consumer debt, the United States is right at the 250% to 300% level. When debt is at that level, even though the Federal Reserve is offering free money to lend creditors, i.e. banks, and not sure they want to continue to lend on their borrowers, start having solvency issues, especially ones that already are in significant debt. So the interest rate cut was seen not based on policy of price stabilization, but rather a desperate Hail Mary. As history has shown us in the past, this will cause a long, drawn-out economic contraction, where debts will eventually just need to be forgiven outright or printed away through money creation that's given directly to consumers and debt holders. So how do we move forward? Now, we won't always find ourselves in this current situation, and things will eventually get better and recover after a few years. And it will be that time that the Federal Reserve will start raising interest rates in anticipation of the economy overheating and causing inflation above their target goals. In that scenario, equity markets and commodity markets, in most situations, won't necessarily fall right away as investors still believe the market conditions are bullish because demand is strong. In fact, many times interest rates being raised is initially seen as indication that the economy is healthy and people will continue to have ever increasing demand for goods and services. However, in most situations, that is a bull trap investors fall into. And when Federal Reserve or the central bank starts raising interest rates, over time that pulls more money out of the system and increases the cost of debt, inevitably leads to an economic contraction. That is why the Federal Reserve starts raising interest rates. It should serve as a strong signal for a passive investor that it's a good time to stop buying stocks and start moving excess capital from income or dividends into cash, which is a good during economic contractions. Case in point, if you would have stopped buying stocks in 2016 when the Federal Reserve started raising rates again and moved into cash when the past 4 years, you may have thought you were missing out on the bull run. But now, it's looking like it wasn't such a bad move, and over the next year, it is very likely it will be a move that could have preserved your wealth. So, then you could take advantage when good dividend-paying stocks start bottoming out over the next couple of years at fire sale prices. A small caveat here would be moving investable income into dividends into gold and silver, not cash, in an environment when inflation begins to rise. In that situation, it would be detrimental to hold cash even while a central bank is raising rates, because history has shown that in many cases, policymakers struggle to get ahead of inflation and it can rise rapidly. Gold and silver are excellent insurances for preserving the purchasing power of your money in those situations. However, as of this writing, that is something I do not think will occur until after 2023. In the end, most markets have booms and busts, and they are all essentially dictated by the largest central banks or national banks' behavior, which is influenced by politics and the world events of the day. Based on those cause and effect relationships, by just paying attention to the policymakers at the Federal Reserve, it is actually very easy to determine which financial instruments will do well and which ones will not at a certain time period. And while your timing will not always be perfect, the great thing is over the long run term, it doesn't have to be. While there will always be caveats and nuances as long as you're using proper risk-reward management and investments in our trades using cause and effect analysis on markets can provide an edge as an investor that bring financial security and freedom. Now, for more advanced intelligent speculating, you can use price action data to determine when buyers and sellers are entering and leaving a market, and when layered with analysis of causes and effects, it can compound your wealth creation significantly. But that's a story for another day. Stay tuned. Thank you for tuning in to another audio article. If you would take a minute to like and subscribe, we would appreciate that. And hit the bell icon if you want to be notified when new episodes are available. If you would like to learn more from the Intelligent Speculator, feel free to join our exclusive Facebook group and interact with Lathan Fritz, the Intelligent Speculator himself, or keep up to date with us on Instagram, Facebook, and Twitter. Good day.